Welcome Adam. Adam is one of the top CEOs and founders in LA with Just Fab, now Techstyles. So probably one of the bigger companies in LA, I'd
Thank
imagine.
you.
So I want to start, so Adam's been on our stage several times too, and I remember one time when he was on stage and somebody asked the question, and by the way, Adam is an expert on branding and fashion. Actually, that's a joke. Although he does run a fashion empire, but branding, commerce, and he also is a partner at Crosscut Ventures, so he also invests. So if you have a question for him, again, we really want to make this interactive. So Adam was on our stage a couple years ago, and somebody had asked Adam, are you a tech company or are you a fashion company? And Adam said, we never looked at ourselves as a technology company. And so, but recently, Just Fab just changed their name to Techstyle. So I have to ask, any reason, if you're not a technology company, why did you change your name and why does it have tech in it?
That's a good question. And I had a feeling that you might go back to that quote because I've had a few other people. I think one is why we changed our name in the first place. So we originally had one brand, Just Fab. Mm-hmm. And then since then, we acquired Fab Kids, we bought Shoe Dazzle, we launched Fabletics. So the name Just Fab didn't fit the entire company. And our mission is to reimagine the fashion industry and really reinvent how brands are built. So we wanted a name to match that vision. And then also we wanted all of our company to be part of one company. So we were starting to have employees that said, oh, I'm from Just Fab, and I work for Fabletics, and I work for Fab Kids. And we wanted to have one identity no matter which brand you focused on. So we knew for sure that we needed a new name. And I do still stand behind that to our customers, we're a fashion company. So they don't view us as a technology company or an e-commerce company. They come and shop with us for the fashion. But how we build the brands is largely through our technology platform. So as Anton, who's our COO, reminded me, is we have almost 200 employees in our technology department and team. Building all the proprietary systems that we run on. So we wanted to have a name that those individuals felt in touch with, and that really drove the vision of we're using technology to create the fashion brands of the future.
Right. Well, I guess you can say that about a lot of the companies, Amazon, bookseller, so they're a tech company. Now they're going to be opening up bookstores and grocery stores, but they're a tech company. So very similar.
Yeah, I mean, it's all a little merged because you use technology for everything today.
So, so just to give everyone the magnitude of your company, because you are one of the bigger ones in LA, just tell everybody you have, what did you say, 200 employees or 400?
So we have 2,000 employees worldwide.
Oh gosh, okay.
450 here in Los Angeles, which is our corporate headquarters. We're a global company. About 75-80% of our revenue is in North America, the rest in Western Europe. This year, we should do a little over $630 million in cash net revenue.
Net revenue.
Yep.
Okay.
Yeah, so it's grown since I think we last spoke. Yep.
And is Fabletics still the fastest growing portion? That's the athletic line, and I mean Athletica is so popular, and I forget that's my favorite. But who's the other one that's really popular in athletic line?
Fabletics.
No. Oh, sorry. Gosh. Well, that's up there too. That's Fabletics. But is that the fastest?
Yeah, so Fabletics is our fastest growing brand, but all the brands are growing at a really fast clip this year. And
you've been acquisitive before. I mean, you bought, as you said, you bought Shoe Dazzle, and then you bought, so you did bring, well, Fabletics was actually something that you actually brought in, was sort of in-house. But as you look out to think of other potential acquisitions, what would you consider?
Yeah, I think, well, one is acquisitions are exciting, but they're also pretty hard, right? Because on top of integrating technologies, you also need to integrate teams and culture. So it's something that we don't take lightly. We've been fortunate that all the acquisitions we've done have been successful, but every single one was significantly harder than we thought. But I do think there's some exciting opportunities out there. You can sort of break them into a few different categories. I think there's new innovative brands with amazing teams that we can put onto our platform and scale very quickly. I think there are going to be retail brands that go through bankruptcy or struggle, but the brand itself is still great, and we could reinvent that brand in business online. And then I think there's innovative ways of selling that we're very interested in and perhaps could be great to bring into our platform. So I think the rental businesses are interesting. Some of the secondhand products that secondhand clothing businesses are very interesting. So if there's a new way of selling fashion, Techstyle, we want to be involved into that.
Secondhand clothing.
Yeah.
So okay.
Yeah, I mean, I'm not.
So if I don't want these shoes anymore, I can put them on some place on your or a potential website.
Yeah, I mean, we're not doing it today.
Yes,
but as I look out there, I think there's ThreadUp out there, and there's some other products. There's some other brands out there.
They've had a lot of challenges, though. But so you can get them on the cheap. Is that?
No, I'm not saying that at all. So, but I think it's one of those businesses that we would probably not build ourselves. But if we saw that business model worked well, it'd be more likely to be an acquisition than organically built.
And then the rental, which is another one, and who's doing? Why is that interesting?
Again,
You're just throwing out ideas,
I think there's a need for it. I think consumers want to shop in different ways. So I think rental could be one of these disruptive to retail business models.
Is anyone doing that? Renting their
clothes?
Clothes?
Rent the Runway.
Yes.
Does it?
Okay, with what wedding gowns?
High-end gowns and stuff, but they've moved more into regular apparel. Gwinny Bee is a new company that's done in the extended sizing. That's interesting. So again, I think those are early categories, but if we were to make another acquisition, it would be something that's very different than what we're doing because it would bring a new competency to our portfolio. Okay,
well that's a nice, and I guess that would from your. Oh, go ahead.
But we feel like we're not planning on at the moment doing any crazy acquisitions. So.
But I'd imagine that's the same investment thesis, sort of if you're for your investment firm, Crosscut Ventures, you're the retail expert, commerce expert, fashion expert. So those are some of the startups or ideas you potentially would invest into, or is that different?
Potentially, for sure. So, Crosscut invested into Black Tux, which is a tuxedo rental business. And if you think about that category, like Friar Tux has been doing tuxedos the same way for 50 years. And anybody who's rented a tuxedo, it is painful. It is so freaking painful.
Why?
So, I mean, one is to do a rental, you got to go there to get fitted. Then you got to go there to pick it up. The tuxedos are 30 years old. And then you got to go back and drop it off again. So there seems like there should be a better way of doing it. So I think, fashion companies, e-commerce companies that solve a real problem or create brands are, to me, what I like to see Crosscut invest into.
Well, you were also in cosmetics. You were in that industry as well. Would you look for, there's this whole health and wellness trend. Would you look for companies that create very healthy cosmetics and with non-toxic ingredients? Would you look at companies like that?
Yeah, to me, I think there's some really established cosmetic players out there. L'Oreal just recently bought IT Cosmetics for $1.2 billion. So there are some new brands getting bought at huge exits. But I think the cosmetic space is pretty crowded. So I think the skincare and the cosmetic space, there's a lot of really established players that have a lot of resources, and so I think that's a tougher category to see startups move into, me personally.
Okay, I want to talk about fundraising eventually because there are a lot of guys fundraising here, but first I want to just talk about you and entrepreneurship. And I've been asking everybody here on stage, and started with Mark Cuban talking about how, I'm going to say this again, it feels like I've said this 10 times on stage already, but selling garbage bags when he was 12, Tree Tran, in a 35-foot boat with 100 people, trying to get to a better life at 11 years old. So what happened with you? What's your story? Did you have any hard knocks when you were younger?
So I started my first company when I was 15 years old in St. Louis, Missouri. And everybody always says, hey, your parents must have been entrepreneurs or into technology, and that's just not the case at all. They actually would have preferred, why don't you go outside and play and be a normal 15, 16-year-old, which I guess I could have taken to be offensive, but I think they meant it in a good way. I started a company when I was 15. I sold that company when I was 18 to Intermix Media.
Oh, that's right. What company was that?
That was Gamers Alliance.
Okay.
So that was a online news and review sites for video
At
games.
15, you were doing
At 15.
Okay.
And then that sort of just set things in motion.
How much did you sell it for? Because that would have made your parents really happy, right?
Yeah, you should think. They were very supportive. So I sold it for $2 million in stock.
Okay.
In 1999, right before the dot-com crash. So for a brief moment, I was a millionaire, and then I had worthless stock.
That's more than a lot of 18-year-olds.
But that's actually sort of what set things in motion, because when I was 18, I thought, oh, this is going to be great. I'm going to go to college. I was working. My day in high school was wake up, go to school, leave school, go to the office till 2 in the morning.
Go to the office after high school.
Yeah.
It wasn't go to sports or play with friends.
Well, I was not playing sports.
Wait, where was your office?
No,
You had an
it was
office?
not. I had an office.
Outside of your parents' house?
No,
at
it was a real
15?
office where we had all of our servers and co-locations, but it was at the top
So
of a
you were
Howard
saying,
Johnson
"Mom and
motel
Dad,
that had a couple. It was not.
Mom and Dad, I'm not here for dinner. I'm at the office
Yeah.
at 15.
Yeah.
Got it.
This, which is why they were, so they just were happy to like, oh, you go to college, don't, whatever this nonsense you're actually doing.
Yeah.
And I turned down $1 million cash offer and instead took stock, and then didn't do any diligence because nobody told me you should diligence who's buying you. And that company had a lot of challenges. So I actually dropped out of high school to go work for them. And that became eUniverse, Intermix Media. So, I then spent like 18 and 19 years old working out of a house in Beverly Hills that had 6 guys living there, 20 people working out of the living room.
This was at Intermix.
That was at Intermix.
Yeah.
And then, fast forward a very long 5 years later, we sold to News Corp. So I learned everything.
For like $500, $600 million.
So that was sort of my college. So I don't really know.
Because you didn't go to college, right?
I did not go to college yet.
Oh, yes.
Yet.
Oh, that's right. You're leaving that.
There's always a.
You can be an honorary. You don't have to go back anymore. You can just a lot of people do that when they get a little bit older, but nonetheless, it's always good to learn. So there's always college. That's great.
Yep.
So let's talk about the fundraising environment. So you've raised what, 250 million,
Yep.
249 million. Last time we spoke, you said that it's been hard, but commerce and retail companies, that's been really difficult to raise money. It's been hard for everybody to raise money, but that sector it's been troubling. So what are VCs saying? What have they been saying about your company that's concerning to them?
Well, I think what was really hard for us was raising the A and the B. The future rounds were significantly easier because at that point we had a much larger company and a proven track record. It
seems easier when companies are bigger and they're doing well. The rounds get easier.
The doing well helps a lot.
Yeah.
I think there's a couple of things that I've learned and passed on. One is to look outside of just Silicon Valley. So I think in Silicon Valley there can be a very specific mentality. One is there's a ton of capital, but there's always a very specific mentality and type of companies that Silicon Valley wants to invest into. So the challenge we had when we did our Series A is we were the number 2 player to Shoe Dazzle. And even though we had a great team, great unit economics, pretty large scale, a lot of momentum, almost every investor in Silicon Valley said, you guys are probably going to do pretty good, but you're not going to be the number 1. And we really like to invest in the number 1 player, and we're unsure what the number 2 player is worth. And obviously in our mind, we were in it for the long haul to be winners, but also fashion is not a winner-take-all category. It's a $350 billion industry in the U.S. No single player is bigger than about $15 billion, so it's very
So why
fragmented.
wouldn't they want the number 1 or number 2? If you were number 2, that's pretty good.
That's
pretty
what I
big.
said.
To them, but
to
they
them.
didn't listen.
But,
Okay.
But fortunately, Matrix Partners said, you know what, we love the fundamentals of the business and invested into it. But it was we got a lot of no's.
It's interesting because there's a lot of startups here who would say, okay, well, there's a number 1 out there. Maybe I need to change my story. So did you change your story, or did you just say the market's big enough for 2 people, and we're slightly different, or were you different?
We were different, but also for us, how we've always raised, this is my own piece, is we really raise a lot on the hard numbers in the unit economics, the media payback, the customer satisfaction, and NPS scores. So. Maybe it would have been better for me to have crafted and changed the story at that point. but we really just came out with, hey, here's our vision, here's the backup of the data, and we raised. Now, our Series A was a little unusual because, we
And how much was that?
That was a $33 million Series A.
That's quite a large
So it was large. So it was more
Series A.
like, in many ways, it was more like a B,
Yeah.
because we had self-funded a big portion of the business, prior to that.
Yeah, talk about self-funding your business. A lot of the people here are looking for really interesting ways to figure out how do you self-fund,
Yeah.
or how do you raise early
This is
stage?
fine. I get into debates with a couple of friends of mine all the time on, if you should self-fund if you can, or if you should raise capital. So my general view is when you go build a company, like it's a long-term commitment. You're going to go spend the next 10 years of your life living, breathing, sleeping that company. It's going to sort of dominate everything you do. So if you have the ability to self-fund the business, I absolutely think you should take the risk and do it. One is, if you're asking other people to risk their money, you should certainly be willing to risk your own. It sends a really strong message to your investors. And then at the end of the day, you'll own a lot more of the company if you have to raise more rounds than you think. And most companies end up needing to raise more capital than they think. We fell into that boat as well. Now, I think everybody has different abilities, so whether that's a small amount or a large amount, I do think it's worth bootstrapping and taking it as far as you can yourself before raising that first capital.
Now, the last time you raised was what, 2 years ago?
Yeah. Yep.
So when you think about time to raise, is it easier to raise money in the private markets or going IPO?
Oh, it's
you're kind of
way
ready.
easier to raise money in the private markets, which is why you see companies waiting longer and longer
Although
to go
some
public.
companies have gone public because it's been easier to convince the public markets than to convince some of the Silicon Valley private later stage investors.
The whole fundraising environment's changed in the last 5 years. So it used to be that to go do a $100 million round, you had to go tap into the public markets. It wasn't even a question.
Oh, I know you can tap into the private markets, but for some companies, they actually can, if they can't get it in the private markets. So,
Yeah.
but for you're saying it's easier.
Yeah,
in the private markets.
I think the biggest piece is when you raise in the public markets, you then have public investors, a lot of regulatory requirements, a lot of disclosures. It's harder to shift your strategies. So there's advantages to staying private as long as you can, but at some point, that's sort of a natural evolution for some companies to go public.
Okay, let's talk about some of the mistakes you made. One mistake you made was taking $2 million in stock, but that was probably
It worked out eventually.
It did work out
took like
eventually.
a lot of years.
That's okay. You had patience. So I guess that's a lesson to learn, is that sometimes you just have to have patience. What are some mistakes you made? What are some expensive mistakes you made, and how did you get out of them?
Well, one is, I've had the same business partner for 15 years. And we've had a lot of success together, but one of the companies we had actually, which was very successful at one point, ended up going bankrupt. So we learned a lot from that. I think the category that you pick is very important. So that was a lesson learned. I think the other one is just being quick about building out your team. So for sure, what happened at Techstyle, this business has grown way faster than we ever anticipated. And when you're really focusing on growth and all the areas you just need to do to keep up with it, you can neglect building out your team and organization. And that's really a problem, because it's like a vicious cycle where if you don't build out the team, there's not the group to help you actually continue to scale. So there's been a number of times in Techstyle's history where we said, oh, we can wait a little longer before bringing on that role. Or, hey, do we really need to build out that department now? So this is a crazy one. So we waited till about employee 200 to really build out a HR function. We had obviously an HR person doing payroll and benefits, but not an actual people department thinking about how do you do succession planning and recruit talent, and how do you maintain your culture at a fast-growing company that's becoming larger. So we waited way too long. Fortunately, we brought in Roxanne Lucas, who's our chief people officer, who's really built out a phenomenal team. But my life and the company's life would have been so much easier had we brought that person in on year 2 versus year 3 or 4.
Yeah, that was actually a big deal for you, because I remember you saying that you had to really go through the process of, hiring people is really you just don't, there's a method to it. And you created this methodology where...
Well, she created the methodology.
Okay, and you adopted it and you embraced it, but essentially that your new recruits were basically, were they taking like self-tests or exams or like personality tests?
Yeah, we're a big believer in this, something called the Harrison assessment, which is sort of like a Myers-Briggs on steroids, but we've actually found that it's pretty accurate and works. So for all of our executive hires, and actually now for most hires, employees go through this Harrison assessment to really figure out suitability from a culture standpoint, and if their strengths were to match up with the role that we're looking for. And
so it's really helped, in terms of when they brought in...
Yeah, it's absolutely helped. But that really, like we look at it as an area of strength now is our people organization, but like investing in that early on, I'd highly recommend, and we certainly should have done it sooner.
So we have about 5 minutes. Does anybody have any questions for Adam? So we'll move to... did you have a question, Cody? What's that?
You saw me perk up?
I did.
Yeah. I'll talk loud.
No, it's working.
There we go. I have a company in DC, it's not my company, a buddy's company called Swaggle that's trying to do high-end clothing for young millennial men that can't afford it. So I would send in my Hugo Boss jacket and I could swap it for points in order to get some sick kicks or some nice slacks of other high-end premium brands that I probably normally couldn't afford, but through this platform I can. So kind of to your earlier point, I know you guys aren't doing it yourselves, but they're looking for their first investor and you'd be a great fit. Just saying.
I teed that up for you, Cody.
Thank you. I was texting.
Yeah.
I had to make.
I think Crosscut would be a great place to send it in and to take a look at. So I think in Crosscut what's interesting is they're really looking to invest in companies not in Silicon Valley. So fits the mold.
Wait, why not in Silicon Valley?
It's not anything against it, but there's just so much VC activity up there. So it's a really well-served market. But what I hear all the time from entrepreneurs in the Midwest or in other states, like, hey, we just don't have access to capital. So I think there's a real investment opportunity when investing elsewhere. So from a personal investment standpoint, almost all my investments have been in companies in the Midwest, where I think the company is effectively at 1/5 the valuation because of their location, which is a great deal for an investor.
Well, he's talking, yes, there's a mic right behind you. So just for the video.
So my question is when did you actually take money and what valuation were you able to get? And are you a publicly traded company now?
So going backwards, so we're not a publicly traded company now. So Techstyle was spun out of Intelligent Beauty. So Don Ressler, who's my co-CEO and co-founder, we self-funded a company called Intelligent Beauty, which was an e-commerce brand incubator. And we took it to about $60 million in revenue before bringing in outside funding. And at Intelligent Beauty, we built 3 separate companies that we ended up spinning out to have separate management teams and into their own corporations where they could either raise capital, go public, or sell. So one of those companies, Dermstore, we sold to Target. Another company, Sensa, while successful for a long time, didn't make it, and we had to close the company. And then Techstyle, which was previously called Just Fab, we started in 2010. So we self-funded about the first 18 million into that business from profits from the other businesses and some of the success that we've had. And then we did our Series A with Matrix. So I don't think we publicly disclosed that valuation, but it was a pretty significant valuation because it was a pretty large scale company at the time.
You can stand.
I know it was a long roundabout answer.
Yeah. So are you an online retailer? You didn't really talk about what your basic business is, and then it sounds like you might be going public in the next 4 or 5 years.
2 year.
Yeah, so what Techstyle does is we build fashion brands. So to date, we've built 4 brands. We have the brands in the fast fashion category, which is Just Fab and Shoe Dazzle. And there, our focus is on shoes, handbags, and apparel. And the unique way that everything that we sell is our own brands. So we're not competing with Amazon because we're not selling third-party brands. So we're designing the product, having it manufactured, selling it through e-commerce and our membership, VIP membership model. And from end to end, we're fully vertically integrated. So fulfillment, customer service, media buying, we pretty much we control the entire life cycle, which allows us to have great margins and pass those savings on to customers. Our other brands are Fabletics, where we're a competitor to an Athleta or Lululemon. And there, we're selling, in our view, Lululemon quality, but for half or a third of the price, which there's a huge demand for. Mm-hmm. And one of our newer brands is Fab Kids, which is clothing for boys and girls ages 2 to 10. But the really unique aspect about our business is the innovative ways that we're building brands now in the 21st century. So if you look back, right, all the big brands that have been built were really built prior to 2000, which means that they were built before e-commerce, before social media, before the smartphone. So like the world is changing how consumers are shopping, but people are still trying to build brands the same way by opening bricks and mortar doors. So I think what we're doing is pretty different and it has been resonating. And we'll continue to launch more brands.
Well, these brands have also been going to the Macy's and these big anchor stores, and they're shutting down.
Yeah,
and
they're in
that's
trouble.
Really changing. So Macy's is closing down. Some of the companies that have these offline presence, like our Pastel, which is somewhat kind of like competing with you, or the fashion was somewhat similar. But so is it just too hard to have an offline presence now? I mean, what's changing in commerce, retail, fashion?
Yeah, this was great, but there's a macro trend that people are not talking about enough that is really a big problem for a lot of these retailers. So if you go back about to 2011, 10, 11, you had about $20 billion in apparel and accessories sold online. Last year, it was $60 billion. And by 2018, it will probably be 85 to 90 billion. So every year you have about $10 billion shifting out of retail and onto e-commerce. Now the apparel and accessory industry is only growing at about 1% a year. So it's not shifting. E-commerce isn't growing in apparel because the category is expanding dramatically. People are shifting where they shop. So if in
the prices are also sort of going down.
There's also deflation occurring.
Yeah, there's a lot of deflation. And
so yeah, there's those two. But on the retail one first is, over the next 5 years, you're going to have almost $50 billion shifting from retail to e-commerce. You have to shrink your store base because otherwise you're keeping costs to have less stores. And a lot of these retail stores just can't effectively afford to have their sales go down. At current levels, they might make 10% EBITDA margins, and if they go down 20%, they go from making money to losing a lot.
Right, so you do see a lot of these big malls now, they're changing, they're shifting, they're like becoming co-working spaces. So, but then at the same time, you have Amazon, which is now kind of creating its own, brick and mortar satellite stores. I don't know what you want to call them. So when you think about fashion, when you see the big Macy's and Nordstrom's shrinking, what's happening in its place? I mean, there's got to be some sort of physical store still, right?
Yeah, I mean, I think what you're going to see happening is the B and C malls are going to go away. They don't serve the purpose that they used to have. Then you're going to have your destination malls that are going to continue to do even better. Experiential, right? Yep. It's where you want to go with your family on the weekend, and there's going to be lots of shopping and activities you can do there. But that might be 10 or 15% of the malls that we have today. Now, some of those regional malls, like the one near me in Palos Verdes here, it's going to turn into a lot of like doctors' offices, restaurants, not really shopping, more like glorified, highly packed shopping centers. But you're going to see the retail landscape change tremendously. The department stores are getting hit the hardest. So anybody selling third-party brands competes against Amazon. Which is a problem if you're a department store.
And just last question, you have a model which is $40 a month. Is that across all of your brands, all of your stores?
So that's the biggest misconception about our model.
Okay.
Is it's not a monthly program.
Okay.
So it's what we call a flexible VIP membership program,
Okay.
where customers each month, if they're a VIP member, agree to visit the site in the
Yes.
first 5 days of each month,
Yes.
where they can either buy or skip the month.
Yep.
So the only time our members get charged is if they don't come back and visit us. And in that case, they're getting a gift card, a membership credit, which is like a gift card
Right.
that they can shop at any time. So the
Right.
key to our model is that our customers are coming back 20 to 25 times per year to look at what we have.
Right, and that's across all of your
That's
stores?
across all the brands.
But
yeah.
you've been getting heat for that, and you've continued this model, and you will continue this model. and
Yeah,
that's
so
not
we
going
now
to
have
change.
4 million active VIP subscribers today. So we're
And growing.
growing,
And-
consumers love it, and we're going to keep doing it.
And maybe an IPO, one of the very few, if that happens. So is that next year?
You know, I can't comment on the timeline,
Okay.
but at some point, maybe.
Yeah, okay. Thank you, Adam.
Great.
Thanks for
Thanks, Bambi.
sticking around.